Hello, hello, hello. What's going on, everybody? Good morning, good evening, good night, depending where you are in the world. Can you guys hear me in the YouTube chat? Let me get a audio and visual check before we start here. No sound? Hello, hello. Let me fix my mic. What about now? It should be good, right? Okay, cool. All right, how's everybody doing this morning? Obviously, we should all know what we're waiting for today. So this is our normal scheduled New York scalping session as per the Capital Hungry YouTube schedule. Monday evenings, we do the market update webinar at 7 p.m. Eastern. Wednesday mornings, 7 a.m. Eastern, we do our New York scalping session. And then Fridays is the self-development live stream video. Okay? Okay, so let's just go through the nitty-gritty first before we start doing our analysis and looking for some scalps to take using the New York session volume. Understand, obviously, the main meat and potatoes today is in the afternoon, focusing on the Federal Reserve interest rate decision. And we're primarily going to be prepping for that, seeing some various scenarios we can see in terms of with what the Fed tells us and the impact it's going to have on the financial markets and how we can also trade that information. I'm still seeing some volume issues or mic issues. Can you guys all hear me? People saying no sound, low volume. Looks like some mixed comments here. So everything good? Put a 1 if the volume's good. Put a 2 if you can't hear me, we're shit. And if you put a 2, that means you heard me still. Yeah, whoever put that 2, that means you heard me to even give the option right now. Okay, seems like we're good. Seems like we're good. Some of these broke people need to turn up those 1993 Logitech speakers. Those big square speaker 1990 beige colored or black speakers. Or listening through their Nokia flip phone right now. All right, we're good. We're good. Okay, so just stream reminders. This is not financial advice, but after we go through the process that is shown in the description, please feel free to ask questions about fundamentals, technicals, overall markets. Don't spam the chat for direct signals. All of your free resources for Capital Hungry are listed in multiple areas. The free news Twitter, Telegram analysis channel, and the YouTube page itself, filled with tons and tons of resources. So it's on the stream reminders little graphic. It's on the YouTube layout, as well as the YouTube description. Before we jump into the analysis, the fundamentals, economic events, and trade ideas, please understand all of us are manual retail traders. We're not institutions, right? We're not the big banks. We have what's called emotions impacting our decision-making process. And just outside of trading, there's a lot within your personal life that can be going on, impacting your emotional state of mind, which can obviously leak into impacting your trading and decision-making process here. The best way to avoid emotional decisions is by having, first of all, a trading plan that you follow, like a blueprint for a builder building a house, and sticking to that trading plan, focusing on the risk management and probabilities regarding trading, not just trying to be some emotional trading hero, trying to call a top, trying to call a bottom, and just jumping from stream to stream. I'm not trying to be rude. The majority of a lot of people fail, especially from the social media platforms where they learn about trading through the social media platforms, because all they do is jump from mentor to mentor, stream to stream, signal chat to signal chat, community to community, and they never themselves put the required time and effort in to actually learn the craft regarding trading, trading psychology, fundamentals, technical backtesting, and so forth. They just think that they can watch these streams, sit there in their Fruit of Looms, and just fucking everything's just gonna process in their unique brain that they have. No, that's not the way it works, right? So remember to follow your trading plan, follow your risk management plan, focus on the long-term vision, and this is the best way to keep emotions out and avoid crashing your account, as well as put in the required time and effort into actually studying the markets in all aspects and levels. Some recent fundamental points we are focusing on. We have seen over the last week and a half that our safe haven currencies have had some short-term strength as uncertainty and doubt has just been developing in the markets, as well as equity markets have had a pullback from their all-time highs. But in my opinion, this has all just been a rebalance of flows as we're coming to the end of Q3 and obviously coming to set up the order flow for potentially Q4. But the order flow setup for Q4 is going to depend on exactly what the Federal Reserve tells us today. The main question we are looking to answer later in the afternoon with FOMC is the Federal Reserve going to start tapering off their asset purchase program and overall support for the US economy, or will they just continue stimulus and keep everything status quo? Right? I don't think I was calling it if you're riding GJ and GU to the downside, but you don't think the feds are going to taper. So that's sort of going against your own little message there, and you might be a bit retarded, but that's okay. Anybody who's feeling a bit retarded and contradicting their own statements, I'm going to explain to you what the impact of tapering is and what the impact of the Federal Reserve keeping stimulus is on the US dollar, which is the world's reserve currency and business currency. Okay, so for you to say that you're riding GU downside but you don't think the Fed is going to taper is contradicting itself. I hope you understand that. But yeah, this week we've been actually taking the sells on GJ and GU, but obviously that was also shared in the Monday market update webinar and so forth. So for anybody who missed that, we were calling some nice GJ sells, GU sells just a day ago in the Monday market update webinar. All right. Don't worry, Mr. Vlado. I'm going to explain to you what the tapering is. Let's just get through some of these things. So now, last but not least, the economic events. So we have U.S. existing home sales at 10 a.m. Eastern, normal crude oil inventories reporting at 10:30 a.m. Eastern, and then the main meat and potatoes is at 2 p.m. Eastern, which is the U.S. FOMC and the Federal Reserve interest rate decision, followed by the press conference. Now, this is what's primarily going to be dictating the movement of the US dollar. And once this sentiment is set in place, everything that's traded against the US dollar is going to follow suit. Pop quiz. Why is that? Why is the US dollar so strong? And also, why has the US dollar correlation over the last year and a half through the pandemic period been so strong as well? Quick pop quiz. Let's make sure we're all awake this morning, you know? Don't worry if you get it wrong. No big deal. Doesn't hurt to, like, you know what I mean? Put yourself out there and guess. So why is the US dollar so strong regardless of what currency pair it's in? And why has the correlations of dollar been so strong over the last year and a half? Those are two questions for the first pop quiz. Vikram, wrong, retard. No, I'm kidding, but you're wrong. Man said tapering risk on. Number one, you guys are correct, because the US dollar is the global business currency, world's reserve currency, and safe haven, right? Debt is also denominated in the US dollar, good one, and the Fed's buying assets through their asset purchase program. All right, so if you guys said, Yeah, so one of the reasons why US dollar correlation has been so strong is no Vikram, I'm sorry. Vikram, please, you watch every single stream, you don't learn a thing. Just stop typing and listen for one day. Don't worry about it. It's okay, man. All right, so let's go through this and look at the US dollar chart standalone. Okay? It doesn't hurt to always give this breakdown. So, when the pandemic first started, and there's a full webinar on this, by the way, as well, which can explain this to you guys in more detail. The US dollar is not strong right now, and I'm gonna show you that, and I'm gonna explain why, Vlado, on a macro perspective here. So just give me a second, right? But if you guys watch this, it'll explain what I'm about to talk about in much more detail. A full hour-and-a-half webinar. Obviously, don't watch it right now in your free time. This is a great one to explain the whole timeline of the pandemic and the central bank actions, as well as the impact it had on the markets and how we traded that as well. Okay. But anyways, so I can see what you're saying, that the dollar here is obviously showing some short-term strength from its lows. I perfectly understand that, which it is showing some short-term strength 100%. But over the year and a half since the pandemic has started, in terms of the timeline, you can see the dollar has actually been devalued, going from 102 all the way down to a low of 90 flat, right? This is primarily because the Federal Reserve heavily and exponentially increased the US money supply so they could take those US dollars and essentially inject the US economy as well as the US markets. So a lot of various assets within the US economy, such as the housing market, commodities market, and stock market, over the last year and a half has been propped up artificially with the support of the central bank and their policy positioning, meaning interest rates being low, excessive quantitative easing, increase in asset purchases. So as the US money supply increases, which I'll show you guys here, the correlated charts, and it doesn't hurt. We got 30 minutes till New York Open. So yo, how about this, guys? It might be boring to some people, but how about let me explain all of this so you guys will understand over the next 30 minutes. Then I promise you, from 8 a.m. New York Open till 9 a.m., we'll look for some scalps for the hyenas. Does everybody agree with that? Let me go through some macroeconomic information for you guys over the next 30-40 minutes, and then the next hour after that, we'll fucking look for some scalps, all right? Everybody cool with this? Just because I know a lot of people just want to take scalps and take trade. Fucking hyenas, man. All right, so let me go through this then. Perfect. People want to learn here. I like that. I like this. So, besides just what happened in today, this year in 2020, this is exactly what happened during the 2008 financial crash as well. If this freaking loads, man. Okay, so here you can see this chart of the US money supply, right? Let's just go to a 5-year mark here. Okay, this is a chart of the not the chart of the US value, not the chart of the US stock market, but a chart of the free money supply within the US economy and overall economies dictated by the Federal Reserve. You can see around 4 billion, much more than that, but this 4 billion mark in circulation is the average standard number, right? Which we've seen on average the money supply slowly creep. Obviously the money supply has been slowly creeping up over the last 10 years with a gradual increase. But when the pandemic happened, we were in such a state of economic uncertainty and needed so much financial support, with people losing their jobs, businesses being shut down, the lockdowns leading to various industries being shut down or suspended operations, and the whole world was in complete panic mode with this cycle crisis that I like to say. What I mean by cycle crisis is whether it's the 2008 financial crash, whether it was Y2K 2000 period, the Great Depression, or the pandemic, these various crises that happen are always a part of the economic cycle to, in my opinion, have a great transfer of wealth, which I have that webinar. But anyways, what I mainly want to show you guys is the money supply having a gradual increase and then exploding when we had the actual pandemic and fear and uncertainty in the markets. So just a quick macroeconomics lesson. It doesn't matter if it's a service, a product, a currency, a commodity, a business, supply and demand impacts everything within the economy. So let's just say you have an apple and you have an extremely high supply of apples, but you have a low demand for it. What happens to the price of the apple? Another pop quiz. If you have an extremely high supply of apples and low demand for it, what's going to happen to the price of the apples, or what is the business owner of the apples going to have to do to the price to make sure he sells it? It's going to drop, right? It's going to decrease. So this is the same concept of what happened to the US dollar value. The Federal Reserve, the central bank of the US, who controls the money supply of the US economy and obviously of the US dollar through their various policy tools, whether it be interest rates, quantitative easing, asset purchases. What they did is heavily increase the US money supply because they wanted to take these dollars and use them in various methods to prop up the financial markets. So when the market crashed, they started purchasing a shit ton of stock market ETFs. They gave the government money through government bond purchases. They gave the US corporations money through corporate bond purchases. They had various different assets a part of their asset purchase program, such as individual commodities itself, as well as real estate properties and so forth. So during the time that the US money supply was heavily increased, you have two things happening. The market demand for the dollar goes down because who's going to be investing in the dollar when the feds are increasing the money supply and taking the dollar and putting it into the financial markets? So you have a decrease in demand in the dollar and an increase in supply, right? So now when we come back to our dollar value chart, look what happens to the dollar value. The same time the feds heavily increased the supply, that 2020 period, and the demand dropped, overall the value of the dollar and the buying power of the dollar went down. Now, from a macro, no, it's not the same increase as the supply in 2008. The increase we saw in 2020 was exponential, like we've never seen before in history. Okay, so now another pop quiz. When you have lower buying power of the dollar, as well as with the increased money supply, economic inflation increasing, who does this impact within the economy? Because what the Federal Reserve is willing to do to prop up the financial markets and make sure the housing market doesn't crash, to make sure corporate America doesn't crash, to make sure after the stock market crash, to continue back bullish and make sure the rich keep getting richer. What they are willing to sacrifice, right? When they are increasing the money supply is a decreased value of the dollar as well as increased economic inflation. But who pays the price of increased inflation and of course the devaluation of the dollar? Okay, so that's a big bands FX. That's a good summary. The rich benefit because all of their various asset prices and their investment portfolios go up, and that's being pumped up with the feds. But the poor, aka the middle class, us, the working class, the 99%, we suffer because we're having two things happen. The buying power of the dollar in our pockets has gone down, and because of inflation, the cost of goods of the day-to-day purchases we make goes up, right? Like your eggs, milk, oil, gas, etc. The main goods people consume, groceries, etc., those consumer goods go up in price because of inflation, but the buying power of the dollar goes down. So the regular working person got double fucked during the pandemic, on top of potentially losing their job and needing the stimulus checks from the government as well. Okay, So let's review this again and look at this as a dissected process, right? US money supply increases, supply up, demand down at an exponential rate that we've never seen before. 2008 was like nothing compared to what we saw in the money supply increase in 2020, right? This leads to a devaluation of the dollar, in which is the Federal Reserve and the rich are willing to sacrifice that, as well as increased economic inflation. At the same time, we understand that all of these US dollars are going into these various assets or stock market. So the stock market chart is the inverse of the dollar chart. It's following the US money supply chart because all of that money supply is going into the stock market after these pandemic low crashes were hit. When this pandemic crash happened, who do you think this is sweeping out? Do you think this is sweeping out smart money, the institutional traders, the feds? No. This is sweeping out the potential retirement funds, pension funds, various mutual funds, or investments, whatever it is, of the middle class, of the working class, and shaking them out of the market, collecting that liquidity, and then when this correction happens and a more favorable demanded price point is hit, the Fed start to use those tools, increase the money supply, and stock market has been bullish ever since. If you look at the oil market as well, which is obviously a commodity, very well protected, same idea. It crashed in 2020 during the pandemic. The reason why oil crashed is because obviously when you had the lockdowns, demand for oil was at record lows, but you had a massive oversupply of oil and overstorage. Why was demand of oil so low? Well, think about it. The world was locked down. You had billions of cars off the road. You had various industries that consume oil and factories that consume oil on a daily basis being shut down. So the demand around the world went stagnant for that first 6 months in period and caused a shit ton of uncertainty. And nobody wanted to pick up the futures contracts because there was nowhere essentially to store any more oil at that time. Same idea. Same idea with supply and demand. You have a massive decreased demand and you have a heavy supply. What happened to the price of oil? It dropped until we got that support of the US dollars going into commodities because oil is a part of the Federal Reserve's asset purchase program. Same thing if you look at the housing market has been extremely bullish. Same thing if you look at gold, 2020 to 2021 was extremely bullish as well. So what we can dictate is, and this is just a few examples, is that whether it's the commodity market, the US housing market, or the US stock market, what has been keeping it so bullish? Is it due to organic economic activity, or is it purely due to the steps the Federal Reserve took? Which one is it? Is oil so bullish because the economies are booming so strong and so much oil is being consumed and people are working so hard and all this, and we're having a whole industrial boom? Is the stock market so bullish because all the corporations are performing so well and we're having a huge economic boom? Or has it primarily been artificial pumping by the Federal Reserve? By the feds, right? So what we can take away and dictate is that dollar movement, right? US dollar movement, stock market movement, oil movement, gold movement, anything against the dollar, even if you're looking at, for example, a pair like GBPUSD, it's going to be the inverse, right? You had the crash. It's going to be anything against the dollar is going to show the same chart as the money supply chart. You had the crash, then continued upside. Euro USD is going to show something very similar as well. You had the crash 2020, then literally continued upside because the US dollar is the world's reserve currency, and that is what has been primarily propping up these various trading instruments and markets. So our takeaway from that is that one of the main market impacting factors from a fundamental catalyst is the Federal Reserve's policy positioning. Okay, so now let's go back to the dollar here. The dollar got devalued from a 102 all the way down to 90 for various reasons, right? Stimulus, QE, interest rates low, asset purchase program, right? These are the steps the Federal Reserve took where they increased the US money supply and then pumped the markets in various fashions through the asset purchase program, quantitative easing, and so forth. But so what does that tell us? That tells us that when we're looking at the structure of the dollar here, and we look at bearish market structure, you have this impulsive drop move, correct? Pullback, double top at this area, and new lows printed at 90. So we had new lows printed by sellers at 90. The last lower highs were here around 94. The only way I see US dollar breaking above 94 is going to be with what? QE is quantitative easing. And that would be a whole webinar in itself to explain. But you could just quickly check Investopedia definition. But I just want to make this very macro and of course just tell you guys the process so far, right? For US dollar to break above 94 price point and correct this downside move and continue back bullish, what is gonna need to happen by the Federal Reserve and be confirmed by the Federal Reserve? Tapering of the so we're going to need tapering of the stimulus support, we're going to need the reversing of quantitative easing, and we're going to need interest rate hikes, right? So what I'm anticipating is we could get a liquidity grab to this area with FOMC, right? But if the Federal Reserve confirms that everything is going to stay status quo and they're going to keep stimulus active, the dollar money supply is still going to be increased and the demand is still going to be in the stock markets, and dollar will make its way back down to these lows. Okay? So this pathway of price for dollar to go back bearish, the Federal Reserve today is going to have to confirm that for the dollar to go back bearish, they're going to keep everything status quo. Now, personally, this is my main bias. I still think the Feds are not going to announce tapering yet. I still think that they're going to keep stimulus active, that they have not seen maximum employment or maximum economic recovery, and they still see some risks involving COVID, and they need more people vaccinated and so forth. So even if dollar does a spike up to this last high price point or 94 here, right? We are still technically bearish on the dollar. And if they also confirm they're keeping stimulus active and not going to taper off, then we're going to continue back down. Now, why do I think they're going to keep stimulus active? Well, remember, let's go back to the stock market chart here. Let's go back to US 30. Okay? What have you guys seen? If you guys were a part of, let's look through the eyes of the Fed or the eyes of the 1%. If you were a part of the 1% and you were buying the stock market from these lows, or every single dip being created, you're scaling in positions, right? Why would you want this greed train to stop? Because all you've had happen is this crash that happened has just been an opportunity. Every single crisis in economic history has been an opportunity for the 1% enrich. So if you think about it, if you're in the eyes of the 1%, if you're a part of the Fed and you have a stock market portfolio that's been riding since these lows and you've been scaling in every single dip, why would you want this to stop? It's only us retail traders who technically go, oh, this US 30 is too high. Maybe it needs to drop more. You know what I mean? I personally prefer, Brandon. I personally prefer US 30, but NASDAQ, US 30, and S&P 500 have pretty much all had the same market structure. You know what I mean? So I personally just like to trade US 30, but all the US stock market indexes have the same bullish market structure and path. Okay? So look at the stock market index here. All we've seen is, remember, the market can only go up in two fashions in terms of reading technical market structure. You have buyers print, let's just say we're bullish, right? You have buyer order flows enter the market, reaching a supply zone. At that supply zone, which we observe technically, buyers extend their gains, they take profit. As they take profit, sellers jump in hand to push price down to a more favorable demanded price point, fulfill more buy orders, and continue back up to the previous high and potentially higher. Or you have consolidation phases, buyer order flow generation, and continuations to the upside. So you either have upside plays, pullbacks, which are profit taking, then buyers jump in from better demanded dip points and buyer order flow getting fulfilled, or you have consolidations and breakouts to the upside, right? That's an easy way that you can break down market structure on whatever currency pair, stock market, gold, oil, doesn't matter. All markets follow that type of technical pattern. Whether it's in bullish or bearish market structure, you're going to see one or the other. Okay? So, what have you seen with the stock market? You get highs printed by buyers and very strong bullish impulsive plays, right? And then at these highs printed by buyers, you can notice some pullback stages or consolidation zones. These pullback stages that occur do not break overall bullish market structure. And then you can see buyers jump right back in from better favorable demanded price points and continue chugging away this greed train that's benefiting the rich. Right? So when I'm looking at the stock market right now, what can you guys identify? First of all, where is this pullback coming from? Second of all, has this pullback broken overall bullish market structure? Ask yourself those two questions. Number one, where's the pullback coming from? Is the pullback or downside move coming from a low? Is it very impulsive and strong? Is it showing us massive uncertainty? Or is it looking like the exact same way we've been trending for the last year and a half? Number two, is it breaking overall bullish market structure? Is it breaking previous significant low points? Right? So number one, the pullback is coming from an all-time high being printed. Then you see buyers take profit from these highs, sellers jump in, and we almost get a pullback here to the previous low at roughly 33,000 flat. Now, what we're going to understand with FOMC today is if the Federal Reserve says we're keeping stimulus active, we're not going to taper yet, we're still going to keep, essentially, they're not going to say that, but we're still going to keep pumping the economies. What do you guys think is going to happen from this pullback stage? What do you guys think is going to happen? Whether it's a consolidation stage or a pullback stage, what can you guys expect to happen? Holy shit, Mr. Clyde. What a fucking retard question when I'm trying to teach you something real. I love you YouTube people. So what do you guys, if the Federal Reserve keeps stimulus active, no, I'm telling you, if the Federal Reserve says we are not going to taper yet, we're going to keep stimulus active, what do you guys think is going to happen on the stock market here? Dollar's going to go back bearish, right? This dip is going to get bought up on the stock market, and we're going to fulfill the range back up to the previous highs and potentially start chugging into new highs. The money printer is going to keep flooding the economy. Okay? So, this pathway of price on the US stock market after this dip has been created is going to be what the fundamental confirms that the Federal Reserve is going to keep the economy. This is what these are the words the feds are actually going to say. All right, we are not looking to start tapering yet. Yes, we've seen economy. Yes, we've seen the economy's When I buy, price always goes down. When I sell, price always goes up. I'm sorry, I didn't mean to laugh at that. It's just funny to read randomly. Anyway. Fucking hell. Anyways. Anyways, alright? If these are the words the feds are going to say that's going to confirm the stock market buys later in the afternoon today, all right? They're going to say, hey, there's still some downside risks that remain with the COVID variant and people getting vaccinated. So that means we're still going to keep the economy in an accommodative state. When they use the word accommodative, they just, for example, the Federal Reserve speaks like lawyers. Very potentially monotone, a lot of big words and confusion to people, and a lot of whipsaw seesaw comments, right? But the main takeaways is you want to confirm that they are not tapering. So if they say that they're keeping the economy in an accommodative state, that means they are not tapering yet. If they say that inflation is still within their range and within their long-term targets, that means they are not tapering yet. If they say there are still some downside risks that remain and they're going to keep the support for the economy, that means they're not tapering yet. If they say that they're not slowing down the or they're keeping the asset purchase program the way it is, that means they are not tapering yet. Okay? If they say all of those confirms they are not tapering yet, you don't have to buy the hero buys. Even once US 30 comes back above like 34,600, very safe buys. So let's zoom in here. And I'm going to show you guys with the US 30 example. So you can see that US 30 is in this pullback stage. For example, let's just say with the feds, if they confirm they're not tapering, we get a heavy liquidity grab, and then we start to continue back up bullish. You don't have to catch the hero buys during the heavy whipsaw move or uncertainty in this area. If you patiently wait for the liquidity to be grabbed, the confirms of tapering delays, as well as stimulus staying active, failing to break the lows and breaking above the 34,300 price point, you still have some very great stock market buys above 34,300 that over the next period of days and weeks, we're going to be looking to extend that back up to the previous highs. Okay? Yeah, the last couple of weeks has been in a pullback fashion as we have buyers take profit from the highs, and at the same time we have to understand in terms of market timing, and with September coming to an end, we're about to start a new quarter, setting up the order flow for Q4. So what I see happening is the Feds delay tapering. They say they're going to keep the economy in an accommodative state. We might have this liquidity grab just to collect order flow, take out early buyers, and like with the volatility that comes with the Federal Reserve interest rate news, then US 30 start to make its way up. Over the next week, the monthly candle closes, the quarter ends, then I'm about to answer that as well, Jamna. But yeah, 30K. No, I think 30K because it's the pre-pandemic price, and I'll show you that. I'm gonna explain the other side after this side. All right. What I'm explaining to you guys first is no tapering, and after this I'll explain to you what I see if they do taper. But yeah, around 30K. All right. And it's gonna be slow and steady correction, not like an impulsive heavy drop in my opinion. But anyways, if the Feds keep stimulus active, which means dollar goes back bearish, continued money supply increase, and continued pumping of the markets, right? We have this liquidity grab and so forth. This new monthly candle might close as is over the next weekly period and close maybe above 34,600. Then I see the new quarterly candle and monthly candle for October probably coming down to retest 34K. And then for the new quarter, all the way into the end of 2021, the 1%ers, the feds, and the market makers milking out the buys on the stock market and housing market so they can go fuck hookers on Christmas. No, not actually, but pretty much just milking out the financial gains until the end of the year, as long as tapering is delayed and stimulus stays active. Because it'd be a perfect order flow setup from this low dip on the stock market to ride those buys until the end of the year for the rest of Q4. You know what I mean? Does that make sense with everybody? But does that make sense? So this pullback has made sense with coming towards the end of Q3, creating that potential dip. Stimulus stays active. We end up still closing bullish. The new quarter and monthly candle gives a bit of a pullback, and we pretty much essentially chug bullish back up to the highs, playing that continued stock market strength and the trend we've seen in the stock market over the last year and a half, right? So we've pretty much seen that same trend. Every single dip in the stock market over the last year and a half. And remember this, right? Even when people were suffering, the markets don't give a fuck about the people. It only matters about what the feds are doing and about their financial market gains and so forth, right? During the 2020 March period, up until the first 6 months of 2020, there was still lockdowns. There were still people who lost their jobs, small businesses that were shut down. The people in general public were still suffering during this time period, right? But the markets didn't give a shit. We are back above pre-pandemic levels by 5,000 points. The whole crash of 2020 and the recovery is 10 times more accelerated than what we saw in 2008. And let me show you guys why. This is the 2020 crash, recovery, and what we've seen happen here. Right? This was 2008. You can see the 2008 crash actually started a bit late in 2007, and the crash took a year, right? This was the not pandemic. In 2008, it was the financial crisis due to mortgage-backed securities within the U.S. market collapsing and having a huge ripple effect globally as well, right? But anyways, this was the pre-crash price, 14,000 on Dow Jones. After the Fed jumped in, the recovery took almost 3 years to get to the pre-crash price, and then another 3 years after that to be like 5,000, 4,000 points above, right? Look at the timeline. The crash itself was over a year and a half. The recovery was over 3 to 4 years, and then years later to continue chugging back bullish. Where with the pandemic, compared to 2008 or other financial crashes, it was extremely surgical and it was extremely fucking accelerated, right? Look at this. Crash happened, 1, 2, 3, crash happened in a month. Pre-pandemic price was 29K, 30K. We got back to pre-pandemic price within the same year. And now we're 5,000 points above pandemic level. Okay? It's crazy, right? It was surgical. It was precise. It was planned. It was a part of the economic cycle. It was coming to that 10-year period where we have economic crashes every roughly 10 to 15 years. And it was surgical. But anyways, now I gave you guys the side of if stimulus is delayed. Now, listen. If stimulus is delayed, oh, sorry. Scratch what I just said. Not fucking stimulus delayed. Freaking giving myself a tongue twister here, talking so much. If stimulus stays active and tapering is delayed, meaning we continue to pump the markets, this is what's gonna happen. If Federal Reserve keeps stimulus active, they keep pumping the markets, they keep the US money supply high, and they don't start tapering yet, we might see a little liquidity grab and price grab on the dollar, but it's going to continue back bearish to potentially over the next month or two go back down to these 90 lows. Do you understand? At the same time, this dip on gold will get bought up on the daily time frame, and if stimulus is still active and tapering delayed, gold might do a liquidity grab and then continue back up bullish as well. Why would gold continue bullish if stimulus is going to stay active? Because two reasons. There's multiple fundamental reasons why gold has been bullish. One, when interest rates are low, it makes it more favorable for investors to hold gold positions for a longer period of time and pay less risk and less overall fees as well over that extended period of time. I'm talking about for the institutional commodity actual traders and holders. Number two is because of inflation risks. Investors hedge inflation increase risks by pooling into gold. Number three, because gold has also been a part of the Fed's asset purchase program. Gold is an asset at the end of the day, just like oil or any of these other commodities or precious metals. Number four is because we trade gold against the US dollar. So if Feds keep stimulus active, dollar's going bearish, gold is going to fail to break these lows and go bullish, and stock market's going to go bullish. That's my main bias. My opinion is that tapering is still going to be delayed and stimulus is still going to stay active, right? But hey, I'm not a fortune teller. I'm not always right. You know what I mean? I wish I was always right, then I could be a billionaire by now. So we, as retail traders, we have to map out both sides of the coin in case we get the inverse confirmed from the Feds. Now this is going back to the question that was told by Jamna Ba Trading, which was a good question. Okay, Jeev, we understand what's going to happen if tapering is delayed and stimulus is going to stay active. But what's going to happen? That debt ceiling thing was already reached, I think, yesterday, Jamna. I think that was sent in the newsroom here. Wait, one sec. Where is it? Yeah, they're still going to be raising the debt ceiling, and I think they're going to approve that alongside the Feds keeping stimulus active. You know what I mean? But anyways, so that was a good question. He said, "Hey, we understand what you're saying now. If stimulus stays active, if we don't get the tapering confirms, this means gold's going to go bullish, oil's going to go back bullish, stock market's going to go back bullish, US dollar by itself is going to go bearish, right? But what's going to happen if they do start tapering? If the Feds confirm tapering and confirm that they're going to start to decrease the asset purchase program, right? As well as reverse quantitative easing, then dollar is going to have the fundamental reasons to break above 94 and start to slowly correct this downside move, because we're going to have the inverse impact. Instead of having a high money supply, we're going to start to see the US money supply decrease due to their tapering, due to their decrease in asset purchases, as well as reverse quantitative easing. If they confirm tapering, if they confirm that they're decreasing the asset purchases, dollar will break above 94 and start to go bullish on the higher time frames, breaking above the bearish market structure point. So this pathway of price on the dollar is, yeah, crypto is going to be affected as well. This upside move on the dollar, right? Dollar bulls, dollar domination, taper confirms, decrease asset purchases, reverse QE, and if higher interest rates. But interest rate hikes only come and happen usually years later after tapering. First it's tapering, then it's interest rate hikes later. But you know what I mean? So anyways, if the Feds give us these confirms, dollar will at least go to 94 and start to break above 94 and start to continue bullish, correcting this downside move. Then we'd also see stock market have a much deeper correction and break below 33K. And what I would anticipate is we would have a larger correction similar to what we saw when tapering happened post 2008, and we're going to continue to extend this bearish market structure all the way to revisit pre-pandemic highs. So if they confirm tapering, this is going to give more reasons for smart money investors to profit take from these highs, sellers jumping in, and over the next period of weeks, we will make our way down to 30K flat, in my opinion, on the stock market. This pathway of price, here is only going to happen if the Feds confirm tapering and decreasing asset purchases. Tapering is just the definition of the Feds turning off that faucet of support for the economy. It's not a light switch where they just close it off and on. It's when they start reversing the policy tools they use to pump the markets. So they start to do reverse quantitative easing. They start to decrease the asset purchase program, right? They start to decrease the money supply in the US markets and economy. Right? Now, I'm going to show you guys an example of why I think we would have that deeper correction, and then from 30K start to go back up bullish, with stock market still being extremely bullish overall. Now, look at 2008. See here on 2008, as well as 2015, when you're looking at the stock market trending for that period of almost 2 years after, you really had minimal dips, right? You had minimal dips and corrections, buyers just jumping back in, continuously taking you to the highs, correct? Until you had this, which was a larger correction in terms of any other pullback we've seen, and then 2015, 2016, you had this. What caused this deeper correction, do you think, during that year's leader period, and what caused this deeper correction? Pop quiz. What was the first cause of this deeper correction on the stock market? Even though it didn't break higher time frame bullish market structure and it caused a much larger dip, what caused this larger dip over that periods of weeks and months? And then what caused the larger dip here as well? And why were these dips larger than any other pullbacks? No, tapering. This first was when the Fed started to do tapering. This was interest rate increases. Right? This was pricing in for tapering that started to happen end of 2012 and going into 2013, with obviously the market prices it in ahead of time. This was pricing in interest rate hikes 2015, 2016 period. You can see stock market still overall bullish, but you had much larger corrections that came with the fundamental confirms of the Fed's tapering. So see here, when you zoom in, obviously here, look at these minor pullbacks, just like what we're seeing here. Minor little pullback, minor pullback. This was still pretty minor of a pullback. Minor pullback, minor pullback, minor pullback. You have this last very strong demand zone. You fail to break the highs, then you get a much larger correction that goes to retest a previous price sensitivity area, almost at 10K flat again. Do you understand? This came when the Fed started to give signals that they're going to start tapering the support given to the economy. This gave more reasons for the smart money to profit take, short sellers to jump in, and for that period of weeks, you had the stock market in the largest correction it's seen in almost 2 to 3 years. Right? Then, as those lows get bought up and the stock market is obviously still overall bullish, because tapering doesn't mean that they're completely stopping the faucet of support. You continue bullish, you don't have any corrections the size of this correction again. Right? You just have pullbacks, continue bullish, pullbacks, continue bullish until here. Then you have another very larger correction during the 2015-2016 period. Right? This was actual interest rate hikes. So now, do you understand why here, the only way I see us breaking below this price sensitivity area and having a larger correction from 33K to 30K is only going to come from tapering confirms by the Feds. Does that make sense? Then it doesn't mean the stock market's going to crash, but it means we're going to have a much larger correction, which I think would line up very beautifully with 30K flat coming to pre-pandemic price points, and then having that larger correction and still continuing back bullish until interest rates are increased again. Do you understand? And it's not going to be as aggressive as the market crash. It's going to be a slower correction because it's not mass fear, uncertainty, or doubt causing it. It's the tapering by the Feds. The reason why gold, that's actually a good question, Mr. Clyde. The reason why gold will have a much larger drop when tapering does happen is because gold is not a currency. Gold is an asset and a precious metal safe haven, right? So when tapering happens, you have multiple bearish impacting factors on gold. One, the US dollar goes bullish. Two, the demand for gold drops and the demand goes back in the US dollar. Three, there's no more inflation risks because tapering combats inflation. Tapering decreases the money supply and tapering starts to decrease that high inflation. Exactly. Remember, one of the reasons gold has been so bullish is because inflation has been increasing as well, and investors hedge inflation risks by pooling into gold, and gold is also a part of the Fed's asset purchase program. So if they taper, the asset purchases go down, that means less purchases on gold from an institutional Fed perspective. If inflation starts to go down, less demand for gold, because why are investors going to be pooling into gold when inflation's going down? Dollar's going bullish as well. We trade gold against the dollar. So you have multiple impacting factors that would lead to bearish impact on gold if tapering happens. Gold breaking below 17, gold is only going to break below 1740 and go down to 1720 and 1680s if we get tapering confirms. Stock market is only going to break below 33K and start to make its way down to 30K if we get tapering confirms. Dollar is only going to break above 94 if we get tapering confirms. And then if dollar does break above 94, GU is finally going to break this demand zone and start to make its way down to these previous price points as well, because dollar will pick up strength and dollar dominates no matter what currency it's in. Holy shit. I don't think tapering is going to be confirmed. I still see stimulus staying active. All right. I'm not saying that's going to happen. I still think tapering is not going to happen. I don't think the stock market is going bearish. I'm just telling you guys why. I'm just telling you guys the only reason we would break below 33K and go down to 30K is if we get the tapering confirms. The only way gold will break below 1752 and go to 1720 and then 1680 is if we get tapering confirms. GU will only break this higher time frame demand zone if we get tapering confirms. Euro USD will only break this higher time frame demand zone if we get tapering confirms. USD CAD will continue bullish on the higher time frames and weekly and break above this supply zone if we get tapering confirms. All right, does that make sense for everybody? Has everybody been following along so far? What my main bias is the Federal Reserve is going to keep stimulus active because I see the 1%ers wanting to continue to chug away their financial market gains until end of Q4, finishing off the year. All right. So what I still think is we still have exactly what Paulo just said. We still have unemployment pretty high, above 5%, which is yearly unemployment still above 5%. If I'm not mistaken, right? Which is very high. Oh no, sorry. Yearly inflation is still above that 5%, and unemployment is still above those yearly figures as well. Full maximum employment has not been reached yet either. Yearly inflation still at 5%. Unemployment is still at high figures as well, and maximum employment has not been reached by the feds yet either. Okay? So what I see happening, and my main bias, is the feds are going to keep everything status quo. They're going to keep stimulus active. Dollar's going to turn bearish. UCAD might reject those highs, and over the next period of weeks start to make its way back down to these lows. They delay tapering and keep stimulus active. Euro USD might do a little bit of a liquidity grab, continue back up bullish. GBP USD might do a little bit of a liquidity grab, but end up still closing back up bullish. Gold might do a liquidity grab, but stimulus stays active, inflation stays high, US dollar stays bearish, continue back up bullish. Stimulus stays active, US 30 stock market index dip, gets bought up, continues back up bullish. Yes, thank you XAU member for I was just confused with the inflation figures. My bad. Talking too much here. Thank you for clarifying that. So unemployment is still very high. Maximum employment has not been reached yet, confirmed by the feds from last FOMC, and I still see stimulus being active. Okay? Did that economic lesson make sense for everybody for the last about 40 minutes now? Does that make sense of what's going to happen if they either don't taper and they keep stimulus active, which is my main bias? Stock market bullish, gold bullish, pairs against the dollar bullish, dollar itself bearish, to summarize. And if they say, hey, you know what? We are going to start to taper. We are going to start to taper and decrease asset purchases. Then it's the inverse of that. All of this is going to be confirmed to us 2 p.m. Eastern today. 2 p.m. Eastern today, this afternoon. Okay. All right. Okay. So now, yeah, I'm just gonna grab a quick drink here. But now we're just gonna go. Now we're obviously understanding that we have the Federal Reserve interest rate at 2 p.m. Eastern. I'm not expecting major. No, tapering doesn't mean increase in interest rates. If you guys rewatch this webinar, as well as if you guys watch this webinar again, or anybody who's asking about tapering, go watch this. Just go watch this webinar here on my YouTube page. It's literally a full hour and a half, fully breaking down the pandemic and central bank timeline analysis. It'll explain everything about dollar movement, interest rates, and so forth. Everything there. What tapering is, what the feds did the last year and a half, the impact to the markets, and so forth. Okay? Okay, now, I'm not expecting major market movements, obviously, till this afternoon. But for the next 40 minutes, we're going to do some quick analysis on intraday market structure for some potential scalps we can maybe take advantage of. All right. I think we're either going to have some price grabs, faceless talks before the FOMC, or we're just going to fucking range and then see the main move at FOMC. You know what I mean? Either we're going to do some price grabs and liquidity grabs prior to FOMC, the big whale setting up their order flow, or we're just going to range and then not see a main movement till FOMC. We're about to go do some analysis now on these various pairs for some quick scalps. So anyways, let's go to gold here, okay? So right now, gold is in a little bit of a range here between 1772 and 1781. Let's just look at the market structure. Anyways, in terms of macro trades, I only see gold breaking below 1747 and taking higher time frame sells with tapering confirms. That's the only way I'm going to sell gold, is we break below 1747 and we get tapering confirms by the Feds. Otherwise, if we break below 1772, I can see some short-term pullback sells to get better order, to get buyers in from better price points at either 1764 buys or 1759 buys to continue up with stimulus staying active. So for my analysis on gold, we can take pullback sells if we break below 1772. But I'm still personally myself going to be waiting for buys at 1759, 1764, or the breakout above 1781. Okay? Yeah, exactly. I'm only, and this safer buys is if stimulus stays active. I'm only selling gold on the higher time frames for long-term positions if we cleanly break below 1747 and get taper confirms by Feds. Then it's very easy sells later on, as well as the new daily candle after FOMC to take the sells below 1747. Otherwise, this is my main bias still, and what I personally see happening is with stimulus staying active. But hey, at the end of the day, I'm not a fortune teller. You know what I mean? I'm just a manual retail trader with the same brain, same resources as all of you. So it's not like my main bias is always going to be right. But at least if we have the fundamental information and knowledge to understand what's going on and why, we can adapt accordingly. So if we get the taper confirms, obviously I'm not going to be taking no buys here on gold. I'm going to be patiently waiting for this, and I'm going to be adapting to that fundamental sentiment and catalyst of tapering confirms. Right? But in terms of short-term scalps, for anybody who is scalping until FOMC, you can take some pullback sells if we break below 1772, but otherwise I'm either waiting for buy setups in the 64 area, 59 area, or break above 1781. Okay? So green boxes are buy zones for me. Where based on price action. Red zones are only, this red box is only a short-term pullback sell if we break below 1772 and then get that liquidity grab. The safest sells for me is only if the Feds confirm tapering and we break below 1747. Okay? The reason why I said I'd scalp below 1772, Stefano, is because we have a little bit of an order block forming. So if we break below 1772, then it shows us more exhaustion and sellers exiting here with potential for a deeper pullback to set up better buys for FOMC later, right? How will you know if the tapering is confirmed or not? By the fucking federal... How do you guys fucking trade? You guys really just be looking at the chart saying, fuck, this looks like a buy right now. Nah, this is sell. No, it's a buy. No, it's a sell. The EMA got hit. We're hitting the golden ratio. So anyways, we're going to know the tapering because I'm going to tell you guys if they're going to taper or not. The Federal Reserve is going to call me. You have to have a special membership with the Federal Reserve. And then if you have that special membership, the Federal Reserve calls you and says, hey, Jeev, we're tapering. Or, Jeev, we're not tapering. All right? So once the Feds call me, then I'll call you guys. And I'll let you guys... I'm just fucking around. We obviously have the fucking... We're gonna find out through the interest rate decision and their statement, right? At 2 p.m. we're gonna find out. All right. Yeah, at 2 p.m. we're going to find out through their economic projections and FOMC statement as well as the interest rate decision. I'm not chirping Burner and his EMAs. I'm chirping the people who only trade based on a singular indicator or a singular reason. Burner doesn't just trade off EMAs. If you like to use that for a confluence a part of your trading, by all means. But if you just trade off like only a fib, only like, you know what I mean? Why are you guys actually sending me your phone numbers? I'm not serious, man. This guy sent me his number, I think. What number is that? I'm not checking that number. It could be a fake. Man, why are you guys sending me your phone numbers right now? I was joking about the... You guys are... Come on. FOMC at 11:30? No, FOMC is always at 2 p.m. It's always in the afternoon. Look, it's here. It's at 2 p.m. here. All right. Okay. So anyways, that's what I see for gold trade ideas. But I really need to go to the washroom. So just give me a second and then we're going to look for some potential GJ scalps to take advantage of through this scalping session until about the new 4-hour candle. Otherwise, honestly, I pretty much think we're just going to be ranging until FOMC. Like on gold, I think we're going to be ranging. GU's dropping a bit lower, extending some of our sell plays, but I think GU is literally going to come down to these lows at 1.36, then continue bullish with FOMC. I might put a buy limit here at 1.36. Actually, I'm only trading gold. I might put a buy limit at US 30 as well at 33,700. But anyways, everybody, I really got to go to the washroom. I've been talking for like an hour straight. Didn't drink any water. Didn't get to really take my morning shit because everybody interrupted me. It was so like, geez, man, start the stream, man. I didn't get to do anything, yo. So my digestive system's about to explode. If you guys don't mind waiting about 5-10 minutes for me here, I need a quick washroom break. Thank you for your patience. Be right back sign is up. That's my washroom sign, the be right back sign. And you guys can watch freaking Raja's broker ad for the next 5 minutes. Okay, thank you for your patience. I'm back. Okay, so now we've gone through the prep of FOMC, what to expect with the Federal Reserve interest rate, if they taper, if they do not taper, the impact it's going to have on the US dollar, as well as the US stock market and commodities. Now, obviously we still have, that is at 2 p.m. Eastern, so we still have some time until then, and this is a New York scalping session. So for scalp trade ideas across gold, GJ, GU, and so forth, I've already given what I think. Right now we're just ranging, but I can see gold breaking below 1772, the new 4-hour candle, and giving some pullbacks to set up better risk versus reward buys at potentially 1764 for FOMC, or the safer breakout buys above 1781. You can see from these highs printed, we still have this bearish corrective structure being respected, and we have not had the same breakout after having this double top exhaustion at the exact same high point, which tells me that once we break below 1772, we have potential for a deeper pullback to get buyers in from better demanded price points, and then continue us up with FOMC if my bias is right. If not, then we're adapting to the tapering talks and the confirms I told you guys. With GJ, when we look at GJ on the higher time frames here, we can see that we're coming to that very key demand zone at 149 that we haven't broken below since March. And this is the last price sensitivity area here that took us into these highs printed at the 156 price point. So you can see this area has failed to break multiple times, and this is also going to be impacted by FOMC. If stimulus stays active, Japanese yen is going to go bearish, Siong. Yes. Dollar and both dollar and Japanese yen are going to go bearish. GJ will most likely fail to break this low area and push to the upside. But anyways, as long as GJ is still above 149, 148.5 on the higher time frame, that daily demand zone, I'm still in a bullish bias on it now that we've reached here. In Capital Hungary, we took the sells down from 151 and 152 down to these lows, but now we cannot continue selling until we break this higher time frame demand zone and have a fundamental catalyst for it. In my opinion, we need a fundamental catalyst to break this higher time frame demand zone, which is going to come from FOMC if they confirm tapering. All right. Yeah, there's a lot of liquidity built up in buy order collection at these lows, and the make or break decision point is going to be the Federal Reserve interest rate this afternoon. If they taper, just like GU, Japanese yen will pick up strength as well, and will finally break below this area. If they don't, this is a perfect buy dip loaded area for those collected of those buy orders to continue right back up as we have been playing this market structure for an extended period of time. But anyways, in terms of scalps on GJ, in terms of scalps, obviously the red boxes are the PPLs following the quarter point theory. You can see we're in a tight range from 149.2 to 149.5. I'm only looking for some GJ buys at the green box areas if we break above 149.5, 149.8, and 150. Even if we come down to these lows again and still fail to break, I'd still be looking for buys in these areas. I am only selling GJ at the current price point we are at if we cleanly break below 149 or 148.8 with a fundamental catalyst. Because Japanese yen movement is not primarily dictated based on Japan's economic state. The Japanese yen on a global scale is treated as a safe haven currency. So when you have stimulus staying active by the Feds and a delay of tapering, all the demand in the financial markets goes back to the stock market. Do you understand? It goes back into the risk currencies, goes back into the stock markets, and the safe havens devalue in the short term. Right? Does that make sense to everybody? Of why FOMC is going to impact a pair like GJ, even though the US dollar is not a part of this pair, is because the secondary within this pair is obviously the Japanese yen, which on a global scale fundamentally is treated as a safe haven currency. So that's why if you guys look at the Japanese yen by itself, by looking at the Japanese yen index, you're going to see it did the exact same thing as the dollar, right? This is the Japanese yen index. Obviously, it's not exactly the same, but you get what I'm saying. Japanese dollar on the weekly time frame, right? Down pretty much just a overall just a devaluation, right? Japanese yen here on the weekly time frame as well. Overall, just a devaluation. Does that make sense for everybody? So GJ, that's why GJ is going to be impacted by the Federal Reserve interest rate decision. What the feds are doing is going to impact the overall financial markets, market sentiment, and investor order flow based on their policy positioning. If they taper, the Japanese yen's also going to go more bullish as a safe haven currency because the demand is going to be out of the stock markets, back into the dollar, back into the yen, out of the risk currencies, back into the safe haven currencies. Now, obviously, you guys have to understand, I've been involved in the financial markets now since almost 2016, right? My first 2 years was straight failure. I probably lost half my salary each year. In the 2 years, I probably lost 50 grand. From 2016 to 2018, pure fucking failure, being a retard hyena. The reason why I call people retards, the reason why I call people hyenas, or I might be rude and aggressive and say people are gamblers and shit, is because I was also like that. It's natural to go along that path of short-term satisfaction, instant gratification, and not actually studying the markets and trying to flip accounts, trying to over leverage, over trading, and doing all this nonsense, following these signals, this mentor, XYZ. I did not start to find success until I actually took trading into my own hands and put the required time and effort day in and day out to backtest the technicals, to study trading psychology, and to study fundamentals and economics. Okay? What I'm trying to tell you guys is, if you are new, the concepts that I'm explaining here are going to be like learning a new language. It's going to be like Chinese. Do not worry and do not overwhelm yourself, because you have tons and tons and tons of resources to learn all this information at your fingertips. You have a supercomputer that you're probably sitting on right now. You have a supercomputer that you look at TikToks all day in your hand. And you have a supercomputer in between your fucking ears in that big, thick skull of you fucking guys and girls. All right? We all have the same brain. We all have the same potential. We all have the same capabilities and resources. It's all about how you allocate your time and effort. I had to learn that the hard way through that trial and error, okay? And through that immense monetary failure. Then I started making money and recovering that loss in 2019. Then I started making thousands of dollars a week mid 2019. Then making $10,000 a week, $20,000 in a month, $30,000 in a month, $8,000 in a singular trade, right? You can come to the Capital Hungry free analysis channel here, where I started to share more of my process. And you can find the first post. And you can go see April 2019 when I started to find success of me still trading penny lots, showing live accounts, penny lots, weekly profit, daily profit, trade ideas, analysis, fundamentals. Even when I didn't have a $20,000 news terminal, which I only bought because of the Capital Hungry business, as well as me developing my trading and having the resources to do so. Even when you don't essentially need this stuff to learn. Is it more advantageous and resourceful if you have the money to afford it? Obviously, 1,000%. There's a reason why Bloomberg Terminal and these things cost so much, is because the information is crazy. But back then, I would just be using public websites. your Forex factories, your investing.com, your economic data websites. I wasn't making thousands and hundreds or crazy amounts of money, but what I was making was real. $400 in the day, $1,300 in the month, or in the week, sorry, right? You can go see my process from 2019 all the way to the current day here, where the last trade I took was a quick intraday gold sell, and I made $8,000 in that singular trade. You know what I mean? Or you can go check through the media. Where the fuck am? And you can go see when I made all live accounts and stuff, 20,000 in a singular day. Right? Showing the trades, live accounts, charts. Sorry, I keep zooming in because I'm opening these images from Telegram. You can come see the wins and losses. It's not like, and guess what? It's not like I don't take losses. What I don't like about social media and about other mentors and services is they don't show the reality. They don't show the trade management. They don't show the wins and losses. Trading is not about being right all the time. Trading is about having larger wins than losses and having, like, for example, trading is all probabilities and mathematics. If you stick to a 1 to 3 risk versus reward on simple scale, meaning you risk $10 to make $30. If you have a 50% win rate on a stretch of trades and you stick to a 1 to 3 risk versus reward and you lose 5 out of 10 trades, you are still profitable. It's simply math. But because of social media, because of all these influencers who only show demo bullshit and just to sell their courses or to sell signals or to sell an algo or to get people to, you know what I mean? Whatever it is, sign up for their boot camp and shit. They only show profits and they don't show losses. And they also advertise unrealistic things such as, oh, my signals have an 80% win rate. I have a 90% win rate. I have a 95% win rate, which at the end of the day, for a retail trader, trying to have a 90% win rate is going to cause pressure to perform and cause you to make emotional errors and mistake, and it's really not realistic. A realistic win rate is 50 to 70%. So if you take a stretch of 10 trades, if you win 5 to 7 of those trades and you stick to a 1 to 3 risk versus reward, you are profitable. A big issue is people don't know how to handle losses as well. Right? But yeah, you could come here and see the days where I was trading penny lots to see the days where I'm trading huge lots. I also just don't do the trading stuff. I like to motivate people. Make sure you go to the gym. Make sure you're eating right. Make sure you're fueling. Make sure you're getting the right mental consumption in terms of what you eat, what you fuel your body with, what you watch day to day as well. You know what I mean? Get people off fucking social media. Get them studying the markets. Yeah, tons and tons and tons. You can see all my old trades. You can see like processes, everything involved, all right? If you go to the Telegram analysis channel, you can literally scroll through this channel for years. You probably wouldn't even be able to fully scroll through this channel, honestly, and read everything. I don't think it's possible. But yeah, look at this, 25,000. Look at this. 25,000 made in that week, but this is what a demo mentor guru will show you. Only the wins. But the reality is, it's a huge trading slip with losses at the bottom, break-even trades and stuff like that as well, which the full slip is shown. But it's all about that discipline, right? But yeah, anyways, enough of me showing off there. You can come look at recent trades, or you can come all the way to the first post. I'll quote it again, just so you understand that nothing here is by luck. Nothing here that I've achieved is by luck. First 2 years, pure losing. After that, pure studying. No, I've never had a MyFX book. I've just tracked my own trading through like my brokers that I've used. So it used to be Vantage and so forth. If I ever go into money management or account copy trading, then I'll have a MyFX book. But I don't give away pure just signals and shit like that or do account management. I do my own personal trading, then do these streams and different webinars and shit that you see here to teach people what I've learned through my trial and error process. And then the capital hungry service is not signals. You know what I mean? The capital hungry service is more like a financial market information database. Right? But anyways, so I'm just trying to tell you guys that for example, all of you guys think, hey man, Jeev's so smart. Wow, Jeevan's so good at trading. Wow, he knows so much information. But I'm not any different, and I'm not more special, and I'm not more gifted than any of you in the chat. That's all I'm trying to explain to you fuckers. My brain is no different than yours. I went through 2 years of straight losing, then went through three to 4 years of straight grinding. Straight literally saying, you know what? This is actually going to take some time and extreme time and effort. You know what I mean? But anyways, yeah, all these webinars on the YouTube page. You have webinars on trading psychology, central banks, gold, greatest transfer of wealth, oil. Listen, the reason why I do this is because I would much rather create a network of people who are on the same mindset as me and also amassing the same amount of information and experience as me, because those are the people who I'm going to want to talk to years down the line, and we're all going to be supporting each other. Listen to this, and something that I studied outside of trading. It's very easy to get rich and generate money within the world. There's millions of ways to make money, but it's very hard to generate long-term wealth. Long-term, one of the biggest contributing factors to long-term wealth is the network you have around you, the people you surround yourself with. As you know what I mean? I'm just honest. It's the people you surround yourself with. It's the network you have. It's the habits you create day in and day out. It's the behavior you change. It's the improvements you make in the support system you have of other people doing the same thing you're on. Because at the end of the day, we're all human. I'm not a robot. Some days I feel like straight shit. You feel depressed, you have anxiety, you feel overwhelmed, you feel like you're carrying the weight of the world. You have all these societal pressures. You have this pressure to make money, this pressure to be successful, this pressure to be in shape and healthy. It can be overwhelming for any of us. But when you have other brothers and warriors by your side who are on the same mindset, you feed off each other's energy. You lift each other up. You push each other in the right direction. Because we're all, at the end of the day, all of us are going to make mistakes. All of us are going to make mistakes, feel like and having those off days. But it's about what we do when we make a mistake. It's about what we do when we're feeling sad. When you're feeling sad and depressed, are you just going to sit there and sulk? Or are you going to continue to work? That's what's going to build your character. That's what's going to build your riches, your wealth, your body, your health. You know what I mean? So remember, Capital Hungry, the private paid service, that's a next level. Anybody in here, I do not only talk about Tornado. I do not only talk about fundamentals. The reason why we're talking about fundamentals is because we have Federal Reserve interest rate today. Remember, look at this. Scalping. You said, hey, Jeev, thanks for fundamental, but can you talk about scalping or bar analysis? What's this say right here? What does this say right here? Capital Hungry Scalping 101 Core Concepts. Let me ask you this. What other guru What other mentor who also has a paid service just like me, right? What other influencer also has this much free content as well? The scalping series is a 4-part series. Part 1, Part 2, Part 3, Part 4. You have psychology webinars on normalizing losses, fundamental webinars, technical. You just don't understand how much information's here. This is on the public free YouTube page. Every single one of these trading streams over London sessions is gonna give you information on chart analysis, technicals, fundamentals, scalping, and so forth. Does Raja have all of these various webinars on concepts, or does he do streams every day on scalping? Remember, this isn't just scalping streams. Let's zoom in here. Read these. Read the titles. It's not just trading streams. You have psychology webinars on your personal self-development. And Raja's my boy. Obviously, Raja has a shit ton of content, shit ton of value. And I don't see Raja as like a part of those. I'm talking about like the Miami marketers. I'm talking about those influencers and shit. Me and Raja are best friends. I don't see Raja or classify Raja as the Miami marketer class. I see Raja as a real influencer. Listen to me. An influencer should inspire you to do the right things. That's what I see Raja as. No. I'm talking about like the Miami marketers, the Q Banks, the Daniel Savages, the fucking Mamba FXs, the Astro Forex. But yeah, anyways, it's all there, you know what I mean? Look at this shit, man. Look at this. You guys say, oh, how's Jeev know so much? How's Jeev know so much? This is how. There's no clickbait video. There's no Rolls Royce. There's no fucking Lamborghini there. There's no, hey, follow this signal, flip this account. Look at this. It's beautiful, isn't it? That's a beautiful collage of fucking studying the markets. Anyways, let's go back to the charts here for a bit. So yeah, you guys have all these resources at your fingertips. The Capital Hungry News Twitter is actually it's not as much information, sorry, as the news terminal. The news terminal is a direct link to the Reuters icon because we have a contract with Reuters icon, and that's for private channel members. But this free news Twitter has already posted 21,000 tweets. My Capital Hungry Twitter bot going off. You guys don't know about this. You guys don't know about this programming stuff. You know what I mean? Look at this. Look at my matrix. This is my matrix screens. Obviously, because people like entertainment more than education. People, like the general masses, like entertainment and drama more than they like to be educated. That's why social media is so popular. Right? But anyways, the Capital Hungry free Telegram analysis channel, the Capital Hungry News Twitter, which has already posted 21,000 news headlines. All it does is just post headlines all day, all night. Right? And the Capital Hungry YouTube page. Okay, everybody. 9 a.m. Eastern coming up here. Luke Trades is trash. That guy's trash. Just a new Raja wannabe. Yes, I do want to automate my trading down the line, but I have to find a developer who can do that for me. All right, though, everybody, I don't want to ramble on too long. It looks like markets are going to range. It looks like markets are going to range till FOMC. This stream has been running for roughly 2 hours. It's the new 4-hour candle. It's the new 4-hour candles right now. And we have Federal Reserve interest rate at 2 p.m. Eastern. Okay? If you guys re-watch this stream, you're going to have a full Federal Reserve FOMC prep, and you're also going to have analysis across pairs. All right? I got to go now, though. I got shit to do. I got some personal things I got to go handle here. And I don't think we're going to get too much out of the markets here until FOMC. We're probably just going to be ranging until FOMC. You know what I mean? If you guys enjoy these streams, if you guys want me to do these more often, do me a favor and like the stream. It really helps with the YouTube algorithm and exposure. And if you guys can also do me a favor, when the stream is done, just comment on the save stream. Once the stream is done, it's going to be saved to rewatch on the YouTube. Just comment on the save stream. Anthony, this is why you're trash. That's why you've been trading those penny lots for years. Just like one of our boys we know. Actually, no drama, no drama. Iron Man, these guys, they're good people. Just old lost people, but they're good people. So make sure you guys send a like and subscribe. Turn post notifications on, as well as rewatch the stream. Tons of information about the Federal Reserve, fundamentals, technicals. Make sure you guys use all the free resources at your fingertips. Anthony, go feed your kids. Don't worry about NYSE. Last time you had trouble feeding your children, you're telling me about your bills. Don't try to act different in a public chat now. Go feed your children and pay your fucking bills. Right? No, you're not. You have bills you gotta pay for your children if you want the receipts shown publicly. About the tough times you're going through. I don't forget and I don't forgive. I never forget. I got elephant memory. I fucking remember everything. You were in Capital Hungry. I know everything. I remember everything. I don't mean to call you out like that, but I don't like when people try to brag and talk all big in the public chat. Go feed your children. You told me to go feed your children. All right, everybody. Take care. Have a great afternoon. I'm going to be doing a session in the private chat for FOMC, but I'll see you guys on Friday for the next webinar.